Good afternoon. Greetings, everybody, and good afternoon, good morning, good evening, whichever part of the globe you've logged in from. I hope you've been enjoying the discussion so far. My name is Hema Srinivas, and I'm from TAI Hyderabad. I'm a consultant in the people development space. I'm a coach, facilitator, and a trainer. And welcome to this really interesting panel discussion on VC exit stories. If you see, investors and founders both wish to work towards a successful exit for their company. And this exit, it's the last stage of involvement for the VC in the company, making it just as important as the entry decision itself. Now, between the VCs and founders, I think the factors of the terms, the timing, and the temperament determine the direction of the exit story. We have a panel of two seasoned venture capitalists, moderated by Mr. Satish Andhra, who's an icon himself in the startup and funding ecosystem. Now, Satish Andhra loves entrepreneurs with grit, clarity, and a focus on execution. Technology startups are his passion, and his investing, co founding, leadership, engineering experience for the past 20 plus years experience in both US and in India, all of them, if you see, they veer around technologies. And he's a person who loves mentoring and evolving ideas into real time business. As the managing director of India Partners, Satish serves on boards of many companies. Prior to India, he was a partner at Venture East, DFJ, and a co founder of Euclid. It's a Silicon Valley startup where he was instrumental in raising VC funding of 35 million plus dollars. An avid sports enthusiast, he's also involved with the Pullela Gopichand Badminton Academy, and he's popularizing sports and promoting awareness of chronic diseases in the corporate world. So over to you, Mr. Satish Andhra, to bring out the various perspectives involved in the VC exit stories. Thank you.
Thank you, Hema, for the kind intro. Of course, I want to start by congratulating TAI Hyderabad, TAI Global, and the entire TAI family, for pulling TGS 2020 together. I think it's glorious teamwork, lots of volunteer effort to put such a great event, during the current time. And, the topic of the panel discussion today is about, the VC version of the exit stories. We all understand that this morning there was kind of the entrepreneurial perspective or the entrepreneur perspective from an exit of a startup. Now we're going to more discuss about the investor perspectives and what happens, from the time funds invest to an ongoing journey and eventually the exit. I have two great panelists, with me. Deepak is partner at Elevation Capital, earlier known as Saif Partners. Saif doesn't need any introduction. They've backed so many great companies, startups to even, in public markets. Deepak himself focuses on consumer, logistics, and SaaS sectors. Earlier, prior to Elevation, he was at McKinsey, IBM. He's an engineering graduate with a management degree. The other panelist I have is Parag. Parag is with Inventors. And again, Inventors is a very well-known name in the early stage technology venture capital business in the country. And Parag, again, is a fairly seasoned investor, having spent time at ICICI, Intel, and GE, and also he had an operating role for a couple of years at Genpact. So you're going to hear from a couple of investors who also have had operating experience, in the past life, now work for great funds, have gone through many of these exit cycles. Deepak and Parag, very, very happy to have you on this panel. Welcome to this panel.
Thank you, Satish.
Yeah. Anything you want to add, Deepak? Opening comments, Parag, feel free to do that.
It's great to be here. Thank you, Satish. And we look forward to sharing our perspectives here.
Parag?
Nothing much to add to that. Yes, thanks, Ty, for the opportunity.
Great, great. So I think let's start. I mean, there are a lot of myths, and everybody knows that, sometimes you have great exits, sometimes, you have okay exits, so you have grand slams and home runs, and then you have singles and doubles in a baseball parlance, and sometimes you have soft landings. But, the world out there, and including the media, of course, comes up with their own versions of many of these stories. Um, so I just want to begin this discussion. Many a times, right, entrepreneurs do ask all of us when we make investments in terms of, what's your thought process about exit? When do you plan to exit? Do you encounter these questions, Deepak, Parag, and how do you think about it? One is entrepreneurs asking this question, you're going to invest in my company, what time frame do you want to exit? But then your own perspective of how do you look at it, what kind of thought process do you go through when you're making an investment?
Okay, maybe Deepak, I'll try first, and you can go next. So I think the reality of the world is that we manage 10-year funds, isn't it? So we have to get into a company in the first 2, 3, 4 years and exit within that time frame. So exit is kind of a given when we sign a contract with somebody. When we shake hands with somebody, signing a contract has a negative perception, but when we shake hands to be partners, that is inevitable, so to speak. I've come across entrepreneurs who have shook hands and then not done their part of the story, so to speak. They've chosen to remain private, remain small, etc., etc. But most entrepreneurs, when they sign up with a VC, they are signing up for an eventual exit of the company in whatever shape and form. As far as the philosophy of exits goes, as Satish, you said, we are fairly early stage investors. We are coming into a company when it is 15 to 30 months old. It takes at least 6, 7 years before a company can mature to the level of exit. So we don't overanalyze it, honestly. And at least my belief about exits is that create a good company and it will happen. I'm not very religious, but those karmanyavadikaraste mafaleshu kadachanam in the Gita has a very good this thing. We couldn't have imagined that, let us say in Red Bus, somebody called Naspers will come and buy us out. We probably didn't even know the name when we invested. So that's the way, at least I would lay out the philosophy.
No, that's great to hear, Parag. I completely agree with you in the sense that all of us work with entrepreneurs and encourage them to build value, right? The product or the solution problem that they're trying to solve and make this world a better place to live and build a sustainable business. And then monetization will happen automatically. And in what form and shape is not something that any one of us know. We take a leap of faith and then kind of get on that journey. Couldn't agree with you more. Switching gears, Deepak, unlike Parag and I, we kind of run, maybe a 75 or $100 million funds. And so we have limited amount of capital. We may invest in Series A, maybe, do pro rata in Series B. Sometimes, we don't participate in Series C, may take dilution. But Elevation, obviously, has tons of capital. And you guys write checks, all the way from kind of seed stage to you could even go and put money into an IPO company or public markets. And how do you view, I mean, with so much capital that you have available, so there's no dearth of capital, how do you make that decision, in terms of when you get into companies and work with entrepreneurs, how do you make these exit decisions? It's going to be a different lens than what I and Parag would have.
So, Satish, as you mentioned, we typically start with Series A and then want to invest as late as we can in a company when it is performing and scaling up. That said, we have a similar constraint around a 10-year fund life. And obviously, independent of the size of the fund, there is a larger portfolio and reserves and capital invested. So at some point in time, obviously, it becomes difficult for us purely from pragmatic considerations to keep investing in the same company. unless we want to do it from a different fund which has its own dynamics.
Constraints.
That said, I think exit is probably one of the most important points that gets discussed whenever we are trying to invest in a company or there is a term sheet discussion. I think it is one of the most sensitive topics, particularly given I think that's the first time founders see an investor at least putting down rights like asking or creating an exit opportunity in a 5 year or a 6 year type of time frame. Uh, so obviously, at least our response to the founders always is that we should look at our track record of investing in India for over last almost 20 years, and there has rarely been any case where our exit has taken precedence over the right interest for the company and other stakeholders. And also, we shared with the founders that while we are the only investors, or we look like the only investors in the next 2 3 years, if the company is growing and scaling up, it won't be just one person who is trying to set the direction of the company, and one person cannot do anything which is suboptimal for the entire board or the other stakeholders. There will be multiple other investors who knows there might be strategic investors. So at any point in time, exit is not an individual discussion. I think it is at every time it is always a group discussion where it always lands in a good zone if all stakeholders are aligned in terms of what's the best path. And I think also at least initially what I share with founders is that it is not exit is not a negative event, at least because an exit is only possible when somebody is entering, right? So it's a two-way trade. So ultimately it's a progressive step in the life of a company if Elevation or any other fund is investing or seed investors investing. There is hopefully a better set of stakeholders that are coming in. There is fresh perspective which is coming in, so it should not be viewed with a lack of faith or that we are not excited by the prospects of the company. Most of the times it is pragmatic considerations, or fiduciary responsibilities of managing portfolio, and the limited life of the fund. And that said, within those constraints, we always try to maximize how long can be, because obviously the company is growing and compounding. It is suboptimal to exit too early.
Yeah. No, I think for all the entrepreneurs out, they're from different parts of the globe. I mean, venture capital funds are like 10 years. They could potentially go get an extension for a year or two in very, very rare scenarios. So first 3 years, most of the VC firms actively invest, and then they grow their portfolio, kind of fourth, fifth, sixth year. And like what Deepak and Parag mentioned, obviously 7th, 8th years, you're looking for exits. And so, well, if a company is doing really well, has chances of potentially doing an IPO, possibly investors, you could work with investors, even early, investors who got along with you, in your journey very early, to see if there's a possibility for them to continue. Otherwise, majority of the investors want to exit in 6 to 7 years time frame. And it's not that they're forcing an entrepreneur to exit; it's just because of the constraints and the commitments to LPs. Switching gears, from now, let's kind of look at from an entrepreneur perspective. So you folks are involved in many companies. You've been anchor investors and you've taken board roles. And I know many of the early stage venture capital firms, unlike growth equity, adds tremendous amount of value in the early stages as the companies evolve, whether it's product launches to hiring or customer acquisition, scrubbing the business plan for growth capital, all of that. What's your advice, and when do you start advising entrepreneurs or startups? Hey, it's time for you to think about exits. You could share some of your experiences based on your journey. How do you bring that conversation live, and when do you have that conversation? Apart from the fact that, okay, there is that agreement understanding in SSA, SHA, and I agree with you, Parag, I won't call it contractual obligation, but there's certain agreement. So, but in general, in practice, how does it happen?
So in the good cases, Satish, somebody approaches the company in the meantime itself. Doesn't happen exceptionally often in India, but in almost every company we have been involved in where the growth path has been decent. No company is on a steady growth path forever, but where the growth path is good, there have been approaches. So at that point in time, you clearly have to take that call of one in the hand versus two in the bush, so to speak. And at times we have had situations where we have been, I wouldn't say the driving force, but we have been suggesting to the entrepreneurs that they not take an exit, and now we are looking stupid. That's also happened, so to speak. And at other times, it is the entrepreneur is like, okay, I've done 7 years of this. I want to move on. I built a reasonable company. Let's go out and find a buyer. That has also happened. Some other cases, even after 8-9 years, you're still stuck in there. That's when you have to push your point of view, so to speak. Get me an exit, even if you don't want to sell off the company yourself. Let us see if any other fund, somebody else, strategic, etc., etc. Even though we have the right, all of us in those contractual agreements have the right to drag, but I know of very few cases in India where a drag has been enforced. So those are the ways in which those conversations start, so to speak.
Yeah,
Go
no,
ahead.
yeah, sorry.
Go ahead. Yeah.
No, it's just building on what Parag said. I think it's a full spectrum. Many times it is internal developments where the company is scaling up, it has achieved profitability. So, for example, which would be the case with the investment that we made in Justal, where a lot of investors had come in while it was not a long time for us in the company, but the company was profitable. And then now they wanted to do a public listing so that they could unlock value for not just for shareholders, but for employees and access capital markets. And I think it was completely an internal choice that the board and the company made, and hence exit happens naturally. Similarly, in the case of Make My Trip, where again they got listed, specialty restaurants where they chose the path to get listed. Many sometimes also it is internal because, as Parag said, maybe, and there is a good case and a bad case. Maybe sometimes it happens the company is doing exceptionally well, but it is small and it is of extreme value to some strategic or a company operating in a similar space, and they come up with a attractive strategic acquisition value proposition, and if founders and investors all are aligned. So, for example, Quickwell for us, which was acquired by Practo, was a similar example where the company was fairly early in their life cycle, had not raised a lot of capital, but was doing extremely well in a niche segment, and it was something that founders were quite keen and interested on. Because they wanted to work in a larger umbrella, and hence it kind of triggered. Many times it is external too, because company is growing, it is approached by external investors who want to have a stake in the company, but the company capital needs are not that much, so they want to buy secondary stakes to increase their ownership, and hence it is not a binary. Today we are in, tomorrow we are out. It is gradually over time you dilute your shareholding through secondary sales to a range of stakeholders. I think the final case is when things are very dark and there is no light at the end of the tunnel, and then I think you all get on the drawing board and see what's the best way to, and what you initially described as soft landing. And I think again there is a combined strategy on deciding for a I won't say it's an exit strategy driven discussion. It is more what happens to the company going forward, and whether somebody acquires it. There is an acquire discussion or a majority control kind of a transaction. Then that's what you engage in. So it's a full spectrum depending on what the situations are. But I would say the biggest variable and the controllable variable to some extent is how the company is doing.
Absolutely.
I think as long as the company is doing well and is reasonably capitalized, I don't think exit either for even investors or for the founders is ever an issue. There are more than always opportunities available, and not terms and conditions which are most conducive.
Yeah. So to kind of really recap for all entrepreneurs out there again, VC exits happen, like I think Deepak and Parag talked about. IPOs happen sometimes. We've heard about Make My Trip and Just Dial. Strategic acquisitions like Redbus, Naspers. Talked about secondary kind of exits or even acqui-hires. So one of the key things, I think, it's not a conflicted partnership, that drives these exits. Actually, it's a coordinated effort that goes into engineering these exits. And I always say this, and having been an entrepreneur in the past, many a times I think VCs, we play the portfolio game, and we all know that. And from an entrepreneur perspective, it's really the opportunity cost. You all talked about, while a lot of them say, it's not a winner take all market, it's a large opportunity, I'll continue. A few years in your journey, are you able to grow at a pace that you envisioned? Is everything kind of coming true? And is it going to be a good outcome? And the entrepreneur needs to have that very honest, candid conversation with investors, and the board, and work with them, collaborate with them to eventually create, the next steps, plan the next steps to get the best outcome. So that is what really happens, as opposed to whatever is written and talked about in media and social media. Many a times it's that partnership and coordinated effort that gets you to the finish line. If it'd be great for our audience, Deepak and Parag, if you could share, how do you go about, some examples of achieving that alignment, between the founding team, the other investors involved in a deal, and somebody could be an angel continuing, somebody could be an early stage investor, somebody's a growth stage or a strategic investor, and then there's a team, who's put kind of their life into the company. How does one go about bringing in alignment, so that at the end of the day, they're all on the same side of the table? What happens? How does one achieve? Any tips and any guidance you can share?
So let me take the example of a Pune-based enterprise software company we had, so Karate, which got sold to Dentsu Japan. It was a 6x kind of an exit, so not spectacular, but pretty respectable nevertheless. So a bunch of very highly technical, good, sound founders who ran the company for a while, ran it very capital efficiently. I mean, didn't raise too much money. So even at, let us say, modest exit outcomes, we ended up making those kind of returns. So I think how it got aligned, so to speak, there was a Series B investor, never raised anything beyond a Series B. So how the founders found a way to align is to kind of, even though it was maybe only 5-6 years into the journey, they took a lot of it as earnouts from Dentsu to make sure that the Series B and the Series A investors got out early. That is the way it worked. There was some sharing between the parties, so to speak, so that everybody would make a reasonable sum and all of that. So all of this evolves over a period of time, and when you have a lesser number of parties around the table, as we had in this case, it is slightly easier than when you have multiple parties around the table, so to speak. In the larger the number of people around the table, let's take a company like Policybazaar in our case. Yes, it might do an IPO and all of that, but there are a lot of investors in there. So those situations, I'm not saying that that's a conflict situation, don't get me wrong, but those situations are harder to manage because of the number of investors around the table.
And especially, if the journey is not going really well, right?
That makes it even worse. I wouldn't like to name companies, but you are absolutely hitting in the right direction there.
Deepak?
No, I think just building on that, if there are multiple, it is relatively easy if there are very few stakeholders or just one investor. But if there are multiple investors, each with a different horizon, different timing, different cost of investment, and then there are multiple co-founders, it is a complicated situation. At least personally, what I have seen, the starting point, which at least creates alignment faster and than otherwise, is if we put the central question all of them ask is that what is in the best interest of the company. I think once we align on what is best for the company and then bake in our individual constraints, it is much easier to arrive at some semblance of an answer, followed by what does the founder actually want to do. I think those two are very fundamental question, and everything else is important. But I think is it at next level in terms of the priority that should be given. And once we kind of hard code and bake those two things, then eventually we are able to find the right answer for individual stakeholders.
Yeah, no. One of my experiences, with an exit, it was because of our fund life. Otherwise, we would have continued with that company, for some more time. It was so shocking that it was a secondary exit. It was a great exit for us, more than 40x. The founders did not sell a single share. They got us an exit, and they were such firm believers in their own journey. I mean, they're continuing, they've raised more capital. So I completely agree. I think, again, it starts with the founders, and they would know, type of investors who've gotten involved, their own limitations, their own expectations. And if you can communicate, articulate, sometimes, folks like Elevation Capital could probably come to rescue of inventors and India, buying out because they have lots of cash, or there are growth stage investors, who would want to, and like Deepak said, somebody exiting is someone's entry. So certainly, but it requires communication, it requires candid conversation, it requires empathy, and then you arrive at a solution. It'd be very helpful. I know I'm also keeping a time check. I think it's 3:10. We have another 10 minutes. In terms of quick tips to founders out there, bought versus sold, right? You want to be bought. You don't want to be sold. What can they do? Can you just share some quick tips? How do they make themselves desirable to be bought as opposed to be sold?
So maybe see, obviously, being bought is far better than getting sold, isn't it? Because then somebody is chasing you, and you can use that somebody chasing you to drive others to the table as well. So that is a very good place to be in. I think if you are looking, especially at M&A, and which is the most frequent outcome. IPOs are sexy, very big, good to have, but that is infrequent, honestly. So if you're looking at that, then the only way to do that is to systematically work on people in terms of keeping in touch with the adjacencies in that community. Some of the founders do it really, really well without making it that obvious, but how they keep in touch with various stakeholders in the process. Some, let's say in Socrates' case, keeping in touch with the various advertising agencies which didn't have too much of online in them in the first place. But Ashish and others kept those things going. In another case, InstaHealth, which got sold to Practo again, that developed through a partnership. So there are these ways. Start off with partnering with people. That's a good way to do it. Keep in touch with the adjacencies. Be out there. Be a known face. People will let people know that you are doing well, not by shouting from the rooftops, but on a one-on-one basis that you are doing well, and good things will happen. Eventually, this is a business of getting your word out there and patience after that, and doing well. Obviously, only then will people bite. Will people buy rather than be bought?
Sure.
So to speak.
Sure. Deepak, any?
Yeah, I think the only thing I would add is having time on your side is a big asset because the suboptimal outcomes happen when you do not have the luxury of time at all. I think that there's nothing more bad than that. And having time on your side also comes from really watching your cash flows, trying to build a sustainable business. Even when you have lots of capital or a lot of investors are chasing you, it is always better to assume that this time won't last and things could turn south. And hence, how do you progressively improve your unit economics? Watch your burn, because when things, if you go through a rough patch and can buy more time, I think eventually things will things turn around, and if your business is valuable, and then everything else will fall in place. Not having a time window kind of disrupts many of the other good work that you might have done in the past.
Yeah, no, I think great inputs, Parag. Having more than a couple of people, absolutely that's a must. Deepak, I think time so that you're not at the end of the runway with no fuel left is very, very critical. So I think some of the questions maybe quickly. I'll ask Parag, you could answer this question. Next one, I'll go to Deepak. How do you kind of early stage VCs want to exit, and then there are late stage investors involved? How does one handle?
Okay, so the best way to handle it is I guess get one to buy from the other clearly,
or find someone else, I guess,
or find someone else. But what happens is at times, especially our experience has been that as a Series A investor, if you sell out, especially early, then people tend to lose faith. And I'm talking about CDs. Maybe at E and beyond, they don't care because you are a small part of the cap table by then. But at CDs, they don't allow you to exit. Angel investors, seed investors are a different cup of tea. But we institutional investors, if you will, find it hard to exit in those BC rounds for sure. That's the only caveat I would say to that question.
Yeah. The other question, Deepak, I don't know if you have encountered this at all in your journey, is more about, what happens if contracts are not, followed or, stuck to, and discussions start outside of, kind of the initial contracts, exit plans.
You mean the exit obligations as detailed in the shareholder agreements are not met?
Right.
See, I think typically that would happen when the company is not doing well, because if the company is doing well, I don't think anybody opens the contracts. There is more and more demand anyways. And ultimately, it has to be resolved through discussions. One thing that I have seen is that if you start litigation or things of those sort, these are short ways to ensure that value is distracted for everybody. So I think either the founder or investor, at least one of them, if not both, has to act maturely and pragmatically and resolve this through discussions, understanding what's the real concern here.
Yeah. Before I think I bring in Hema to kind of wrap up, just for the audience benefit out there, all VCs have their fund life cycles that they care about. Exits could come in many options for investors: IPOs, strategic acquisitions, secondary sales, rarely company buybacks. Certainly, in terms of it's the entrepreneur decision when they want to exit, but they do seek guidance from the board and the investors. When you're preparing for an exit, make sure that, like what Parag said, you've looked at the ecosystem, understand, who are the players who potentially would like what you're doing, and make sure you have enough time. And in terms of investors, how they exit, I think they take care of themselves. I mean, while, they talk to company, it's not that they're only dependent on the company. There are also other conversations they're having on their own as well to just help and not to distract the founders many a times. But while keeping the, team in the loop if they want to exit. So that's kind of overall summary. Hema, if you want to chime in now, given that we have just 2-3 minutes left. If you have any questions from the audience.
Yeah, there is an audience question. There's somebody who says they have patents across various countries and they hold a certain stake in the company, and they need to be acquired, not sold for a discount. And the investor has kept his commitments. So the question is, what's the best way to move on with legal hassles?
It's very generic. It's too tough to answer without knowing the context. I don't know if Deepak or
maybe let me revise the question to say, What should we do what should founders do when they get into to avoid legal hassles, and to maybe what's the best way out if ever you are in one?
Legal hassles regarding what? I mean, that's something I don't understand. What
Okay.
exactly are the legal hassles about?
About the exit process, I suppose that's the question that was asked.
Any comments, Parag or Deepak?
I think if it is legal hassles between the investor and and the founders, then as Deepak said, that's a
God
very
bless.
bad place to be.
God bless.
That's then we are just fighting in our courts, and the only guys who make money are the lawyers and accountants, isn't it? So never get into that. If the question was about IP, if I heard Hema articulate that, then spread across, that could be a very specific problem. As Satish said, you might want to get to an IP lawyer in that case and seek inputs. I think at this 30,000-foot level, it would be wrong to advise, so to speak.
All right. So, are there some things that VCs actually, like, if you can give a tip in terms of what are some clauses you all look at, or what are some risks that you all kind of look into when you all are investing?
I think all of us are early stage investors. I think none of us have any clue. I think we take risk, we get in there. And most of the time, I think those contracts go sit in the closets
Okay.
after you're done, because you're very busy working with the founders, building the company. I think if you're going to dust them and start reviewing them, then there's nothing much left for either the investor or the founder. That's what I think both Deepak and Parag said. So very rarely, in the venture capital side of the story, of course, if they grow non-linearly very fast, raise large amounts of capital, new liquidation preference structures, overhangs, come in, and that gets complex, and that happens in few scenarios. But in general, I think these are standard templates. And if you look at countries like US, I mean, there's NVCA, Venture Capital Association, pretty much, everybody follows that standard template term sheet, and more or less the same, I think, in India as well. I think there's
All
a
right.
standard term sheets out there.
All right. So on that note, thank you very much, Deepak Kaur, Parag Dhol, and an excellent moderation by Satish Andhra. I think the takeaway for all of us listening in is how is it, and we got an insight into how is it that VCs actually make some of these decisions, and how not to treat exit, which is actually a sensitive topic. What are some of the pragmatic considerations that you look at from your side? How the founders, the other groups of investors can actually make a coordinated effort in order to kind of smoothen and facilitate that exit process, and tips for the exit process. Thank you very much. It's been a really invigorating and a knowledgeable session. And yes, wish you all the best, and wish all the participants successful journeys in their endeavors. Thank you very much.
Thanks so much,
Thank you
Hema.
so much.
Thanks, Parag.